Good morning and welcome to the Brazilian American Chamber of Commerce's webinar called The City versus the Suburbs, Residential and Commercial Real Estate in 2021. I am John Welch, Executive Director of the Brazilian American Chamber. Let's start with Manhattan. Freddie, would you please give us your thoughts on the state and dynamics of the Manhattan residential market?
Good morning, John. Good morning, everybody. The Brazilian American Chamber of Commerce. Thank you so much for the opportunity here. We've had since 2016, because of policy-driven decisions, from a seller's market, we started going into a buyer's market. From 2012 up to 2015, as you can see in this chart, it was a seller's market. Condos were selling at really quick speeds with very small negotiability margins. And in 2014, close to 30% of condominiums in Manhattan were sold at or above the asking price. And then from 2016 all the way to last year, we've entered into this neutral and into a very strong buyer's market. Is this still a buyer's market? And according to the data, we are officially in a neutral market, and was the best January in the residential market in Manhattan that we have had since 2014. Now, 2014 was an extremely active market. And so if this trend continues, then 2021 is poised to be a really strong market for sellers. The number of sales in February, as of February 11, 2021, you look at a 40% increase. A lot of Manhattanites that didn't want to leave the city altogether made decisions to leave to Brooklyn and Queens. And so in the beginning of the pandemic, many areas of Brooklyn resembled the suburbs, where activity never ceased. It actually increased compared to, say, Midtown Manhattan, which in the many months after the pandemic was still very quiet. And you can see that the median sales price is 10% higher than the same period last year. When we look at the rental market, that one has been suffering a lot. And we look at vacancies, Manhattan residential, New York City residential vacancies have always hovered around 2 to 3.5%. They estimate this number to be close to 25%. This has caused price declines anywhere between 15 to 20 to 25%, depending on the neighborhood.
Thank you very much, John. Thanks everyone for your time. For office space and the commercial market in general, the most glaringly important is going to be the rapid decline in employment. Prior to the pandemic, the city was at an all-time high of around 4.7 million jobs, with nearly 1.5 million office-using employees. In the months following the city shutdown in March, nearly 1 million jobs were lost, which was almost as much as the entire total that we had gained over the past 10 years. Jobs began to return to Manhattan as early as July, and to date, the market's added roughly 60,000 office using and 370,000 total jobs back. The most immediate shock to the market as a result of COVID was the fall off in leasing activity. Renewals, however, held fairly steady, with monthly activity down less than 1% compared to pre-COVID, and the reason for this is kind of two-pronged. First, many tenants with near-term LXDs opted for short-term renewals in order to postpone making any major commitments during a time of such uncertainty. And second, landlords were also much more aggressive with renewal pricing than in years past in order to retain existing tenants as a result of the lack of demand elsewhere in the market. One of the last major changes in our marketplace today is the increase in sublease supply. As many firms with near-term LXDs opted for short-term renewals, a large number of companies with potentially stressed or evolving business models chose to offer significant portions of their space for sublease in order to cut costs. On this next slide, we're going to discuss a little bit why rents haven't started to materially decline yet, despite all of the stress that we've been discussing. In short, the answer is that we didn't really expect them to yet, as there is generally a lag between vacancy and asking rent cycles. Asking rents took 3 quarters to change their upward trend after the dot-com bust and 6 quarters post-GFC. In the 3 quarters post-COVID, asking rents have held relatively steady and fallen in total around 1%. There are a number of reasons for this phenomenon. But the primary reason for this is the lack of leasing activity. Without demand, the market isn't able to as efficiently price their space, and landlords will generally refrain from making any more rash decisions and slashing any asking rents. So when we look at our market vacancy over time, vacancy rates in Manhattan were already on the rise prior to COVID, but this trend has obviously accelerated in the months since the pandemic hit New York. Our baseline scenario projected vacancy to hit 16.5% by year-end 2020. In real time, our finalized year-end numbers found vacancy hit 15.2% overall. However, if we were to include the shadow space that we're tracking and we expect to come online in the first half of this year, that vacancy reaches almost 17%. The rest of this year, we expect to witness the bulk of new supply that will be added to the market, and this results in our baseline forecast peaking around 23.1% by the end of the year. In 2022, the baseline expectation is for job momentum to begin to build as the population is almost entirely immunized, economies reopen in a more unfettered manner, and both business and consumer certainty begin to return to the market.
We're seeing about 10 to 15% of the workforce even showing up to the office. If you look at Cushman and Wakefield's office here, we have several 100,000 square foot floors, and they're virtually empty, and that's what it is throughout our portfolio. We have companies that have been in business for 20 years whose leases are expiring. They're going to stay in business. They're opting to close their offices, work remotely entirely. These are billion-dollar hedge funds that are willing to postpone making a decision today and even close up their offices and wait and see. And so all the major tenants out there are talking about coming into the office end of summer at the earliest. A lot have already switched and they're coming into the market in 2022, coming back to the office. So what you're seeing is you're seeing no activity really, as you saw from Marc's statistics, there's really virtually no activity going on. Those people who are renewing for 1 or 2 years now and just waiting to see what it's going to look like.
So first of all, I want to thank everyone for the invitation. When COVID hit on March 2020, that was a boom. Really, everywhere in the suburbs, people want to move. Put here the Metro North Railroad map, and you can follow these cities one by one, and that's what people want to be. From half an hour to 1 hour from New York. They all work in New York. They have to go to New York. They love New York, but they want to live in a place that's not more than 1 hour from New York. We have bigger houses, great entertainment spaces, and good prices compared to New York. So after that big wave of people coming in March, April, May, prices went up, very quick sales, as I'm going to show you, and multiple offers and closing prices over the listing prices. Quarantine really changed the way we live and the way you work. They need more space to be in their houses. Sellers are pricing their houses very well. One thing I have to tell, and I would like to say, is be prepared. When you come to the suburbs to buy now, you have to have your pre-approval letter in your hands. You have to know what you want, because you have to have your documents all in place, because if you like the house, you have to make an offer. Even if you get back to work, you're not going to work every day. Even if the kids go back to school, they have some days, they will stay some days in the house too. The great appeal of suburbs, it's not price, it's quality of life. It's way of life. It's a different lifestyle. It's a different lifestyle. I like to barbecue every day on summer, have my friends or at least a small group of friends in my house. So the way I see the market now, it's going to stay at least for the 2021.
One thing that you mentioned, Cristina, during your 2020 days working there and also to this day is the number of New York City renters that you helped make their first time home purchase in their lives in the suburbs. And what interesting characteristic of these customers is that the vast majority of them didn't even own a car. And you'd basically pick them up at the station and do an entire in-depth tour of their new town that they were going to call home. And I thought that was very interesting because in my mind, these price points, they are relatively cheaper compared to Manhattan, but they're still much more expensive than the average US home prices. And in my mind, I always distinguished renters as being in one category of affordability versus home buyers and owners. And yet a lot of them, in your experience and your colleagues there, migrated from renting in New York City to buying their first home in the suburbs, right?
So a lot of the trends that we're seeing in the tri-state area in general really tend to mirror New York City overall, with a few kind of key differences. Mainly the market in Brooklyn. Brooklyn has really uh, changed greatly and will continue over the next couple of years. There's an incredible amount of new construction in the market that hadn't really existed in a very long time. Unfortunately, the timing of this downturn mixed with that development cycle is slightly problematic for the market, and we're already seeing vacancy rates upwards of 20% and may reach as high as 30, depending on if they're able to get tenants out to that area. Overall, a lot of the focus of the more suburban markets has been very driven by the industrial market. If you look between New Jersey and the boroughs in general, Amazon's actually leased more industrial space than the entirety of the office markets over 2020. What we kind of perceive to be the main trends for the suburban office markets is going to be how companies come to the decision to reoccupy. I know John and I have had a couple of conversations with clients that are really kind of discovering this hub and spoke model. And a lot of them have actually come to the idea on their own. There was one that had a disaster recovery site in Westchester area that they never really used for office space, but now they were able to fit it for 5 to 10 employees, and they have absolutely loved the shorter commute and ability to have a little bit of an area set aside to focus. And now as a result of that, they're thinking about lowering their total footprint in the city and maybe adding a few other small sites, maybe in New Jersey or Long Island, so they can have a few options for their employees, not only to have a really close option to commute to and focus, but then they still have that central point where they can all gather together in a larger conference room, have a few more of the bells and whistles to entertain clients, or you name it.
There's going to be a return somewhere after 2021 back to Manhattan. Doesn't look like a full return. Maybe it is in 2025. But you think they'll maybe use the disaster recovery areas for somewhat sort of in between transition? Certainly they're going to keep all the computer systems and stuff like that there, right?
You know, I think it's forever changing. I think the people, when you think about disaster recovery, you're thinking usually in the past, you're thinking where there's no power in New York and there's no communication in New York and you need a place to go. So I think it's forever changing. And the idea of putting everybody together and trying to house them in this big operation. And that's what we had done in the past, is tried to get people, sorry about this buzzing in here, is we tried to get everybody together, and it's just changed forever. It's just not how people are going to occupy space. The idea, another trend that we're seeing, the idea of having everybody in these huge open trading environments. Over the last 10 years, everybody's been densifying. They've been taking less space per employee, and they've been putting everybody in these large open spaces. That's why Hudson Yards grew so well, is because these new buildings have few columns and you can just put thousands of people on a floor together. That's changing. So the way that people are occupying space, the mentality around it, nobody knows where it's going to go. But the idea of having a hybrid work environment is attractive to employees. And now we're talking to HR people at these major banks who are looking to offer that to employees as a way to incentivize them to come work for their company. The only negative here is that when it comes to the younger employees, the people who are in their 20s, they want to come back to the office. They're in an environment where they have 2 or 3 roommates. They're in a small 2-bedroom. There's nowhere to work. They're working on the floor, and they're on their bed, and they want to come back and they want communication. So I think in the long run, you're going to see people coming back to the office, but in the short run, I think there's so much unknown as to where this is going to go that people are just sort of not making decisions because they don't know what the world's going to look like. And I think that's the biggest change that we've seen.
We anticipate that the allotment of remote work is going to increase from, historically it had been somewhere between 3 to 5% was pure remote. But going forward, we are anticipating that to end up somewhere between 10 and 15%. But what really changes is the amount of people that are going to have flexible work environments, where it's going to be a hybrid model, a little bit of both. And obviously that allows companies to potentially decrease their footprint.
Because we've had this this narrative last year, New York City is dead, everybody's gone, there has been an exodus. When you really drill down the statistics, that number was only about 5% of people. The 95% is still here. And as Marc and Jonathan mentioned, the younger demographic has not left because they don't want to leave. They want to be in major urban centers for the socialization. And frankly, the moment of buyers now, renters becoming buyers, it's a financial decision, not just a lifestyle decision, because they're going, I can't afford any of these suburbs because they were already expensive before. Now they're more expensive than ever. And the competition is so intense. Actually, in Midtown Manhattan, a place where I never thought I would be able to get a deal, all of a sudden, I'm able to get, a 10% discount versus what they were priced for 5 years ago. And so that's where we're seeing these people making purchase decisions. And even the people that need more space, they're basically going from the 1 to 2 bedrooms. Or a lot of the people that I've helped as buyers, and colleagues have echoed the same thing, is they desire a little bit of a suburban feel to their life, so a little bit of an oasis closest to nature. So a lot of them have basically migrated to the extremities of Manhattan. We've been seeing a lot of people wanting to buy by the Hudson River Park or by the East River Esplanade. So, and a lot of my colleagues who are selling new developments in those buildings are getting local buyers who are echoing this desire. We anticipate that once the borders open up again, the prices are going to go even higher, because all of a sudden you're going to have a lot new buyers competing with the local ones.
That was really excellent. Thank you very much, Freddie, Cristina, Marc, and Jonathan. It was a superb discussion, really. Before we close, I'd also like to thank everybody for joining us. Thank you for joining us, especially to our members. For those that are not, please watch the brief video that follows, and we invite you to join the chamber. In the meantime, stay healthy and in good spirits.